AccuWeather's preliminary estimate for total damage and economic loss from the fast-moving, wind-driven infernos in Southern California is $135 to $150 billion in total damage and economic loss, a truly staggering number reflecting the scale of this horrible disaster across the Los Angeles metro area. Of course, we're looking at things like the amount of insured damage that's occurred and uninsured damage. But far beyond that, we're considering things like disruptions to commerce, the cost of job losses, businesses that may never reopen in the affected areas, tourism, in fact, damage to infrastructure like sewer, other utilities, gas lines, things of that nature, even roadways. And then we're looking at the long tail of costs that are going to be associated with this, including the cost of relocation for so many families, tens of thousands of families who are going to need to find shelter elsewhere in the short term and perhaps for many months or years. The cost to clean up all of this debris, the long tail of impacts, negative impacts to tourism in the area, and also the long tail of impacts, costly impacts, and dangerous impacts to people's physical and mental health. This may some of those impacts may last for years to come. Having such a destructive hurricane season, a very destructive tornado season with lots of tornadoes across the United States, and now just a few days into 2025, a significant historic disaster in terms of wildfire across Southern California. That is a state that's known for wildfires and in California and particularly Southern California. But what was so different about this is that it occurred in a densely populated area with some of the most expensive real estate in the entire country. That's why this disaster is clearly going to become California's most costly wildfire in modern times and may become one of, if not the top, most disastrous wildfire and damaging and costly wildfire in U.S. modern history. AccuWeather has estimated total damage and economic loss from the major disasters in the last 12 months. When you sum up all the estimates that we have presented, that comes to a total of $606 to $674 billion. So almost $750 billion. Said another way, about 2.5% of the United States average annual gross domestic product. That puts it into context of just how significant these losses driven by natural disasters have been when they're registering that high a number as compared to the gross domestic product of the United States.
We woke up this morning in Los Angeles to see that potentially 10,000 homes or more have burned in the Pacific Palisades area. It looks like a warscape here, but Californians should be comforted if they are insured. California home insurance companies are there to protect them in the wake of these disasters. So I think what California consumers can expect is a long road seeking compensation in order to rebuild. Fortunately, we have a lot of protections in California law to ensure that consumers get the benefits that they're entitled to. But we have no doubt that many consumers will face a long uphill battle to get those claims paid. What consumers should know is that insurance companies have a lot of money in the bank to pay these claims, but if they run into trouble, there is a backstop for the home insurance market here in California. It's called the California Insurance Guarantee Association. So in the worst case scenario, if an insurance company doesn't have the money to pay its bills, that guarantee association kicks in to pay homeowners' claims instead. For the FAIR plan, if the FAIR plan runs out of money, the home insurance market steps in and they'll be assessed to pay the damage. There is a risk, however, that the state insurance commissioner will let insurance companies pass on those assessments to consumers. He's announced that he's going to allow that to happen. And in that worst case scenario, we have legal options we can consider to address that and prevent consumers from having to pay the bills if the FAIR plan can't pay its bills. But I think they're in the immediate wake of this crisis. We're urging consumers to keep track of everything, to document their receipts if they've had to evacuate, to document their phone calls with insurance companies once they're able to start making those calls, and then to seek assistance if they don't think the insurance company is treating them fairly. Well, there's something really important that California consumers should know who are in the fire areas. California has a consumer protection law that says in the wake of a wildfire disaster, insurance companies are prohibited from non-renewing consumers for a full year. So anyone in a fire zone or in the surrounding zip codes, whether it's Pacific Palisades, the Eaton fire, they will be protected from non-renewals for the next year. And that will be particularly good news for consumers who may have gotten a non-renewal notice recently that hadn't yet taken effect. Those non-renewals will now be paused. You know, one of the problems that we're facing here is that the insurance industry started pulling out of certain areas in California. That forced many consumers onto the California FAIR plan, which is our insurer of last resort, which means they have too many policies now. And in the meantime, insurance companies were not crediting consumers for having taken significant steps to protect their homes from wildfire. I spoke to a homeowner who basically rebuilt their home in concrete and still got canceled by their insurance company because of fire risk. So we need new protections in place to prevent insurance companies from abandoning consumers who do the right thing and harden their homes, meet state wildfire guidelines for brush clearance and home protection. That way we can make sure that Californians who do the right thing can maintain their coverage. We create an incentive for other consumers to do that in the future, and we stabilize the home insurance market. So that is a reform that's desperately needed in California to start getting insurance companies covering Californians again.